right. Good afternoon, everyone. Welcome to this TradeStation webinar. It's great to see everyone connected here today. Thank you for taking time out of your schedules to learn a little bit about options. Today we have a guest speaker, Brandon Wendell. We'll get to him in just a moment. But we're going to talk about market chaos and how to use options to manage that volatility. So it's a great concept, and we're going to go through different examples of how you can reduce your risk and manage your risk. Before we get started, we do have to go through some of the disclosures. And for those that don't know me, I'm Jesus Nava, Director of Client Training and Education for TradeStation Securities. Keep in mind that every symbol and an idea that we talk about is for educational purposes only. TradeStation doesn't make any recommendations. Also, active trading, not suitable for everyone. And past historical performance is no guarantee of future results. So we're going to go through some examples. Those are not recommendations. Also, keep in mind that Brandon, even though it's a pleasure to have him here today, he's not affiliated with TradeStation, but he is a trader, he is a mentor and an educator, and brings years of experience trading stocks, futures, and the main topic of today's presentation, which is option spreads. So, Brandon, it's a pleasure to have you here today, and I'm just going to pass the floor over to you. Thank you for being here.
All right. Thank you very much for having me. Hello, everyone. Welcome, everyone. My name is Brandon Wendell, as Jesus introduced me, and I'm going to talk about navigating market chaos because we know we get a lot of that. Volatility's been crazy. Things have been happening quite a bit in the markets. So we're going to talk a little bit about that. And my background, as Jesus mentioned, I'm not going to spend too much time on me because this is about you and education. But I've been involved in the markets for about 30 years. I started off as a retail broker, moved into back office operations, and then went into private hedge fund trading for a little bit, came back and went into education and found my niche. Really enjoy helping people, mentoring, and it helps me to be a better trader. So I'm going to share some knowledge that I've gained over the years. And I've been through many market crashes, 2008, 2000, in multiple markets throughout the world, actually. Like I said, I'm just going to share some of that knowledge with you. So we'll get right into it. Of course, if you have any questions, you can type them into the chat as well. I will be monitoring the chat. If the topic is not really on point for what we're talking about at the moment, I'll ask you to save that question until the end. I'll have an open Q&A. We'll go about an hour here. And of course, this is recorded, so you'll be able to go back and rewatch as much as you'd like. And we'll jump into that. So, like I said, what we're going to cover today is understanding volatility a bit and how it relates to options for the most part. What does volatility do to us when it comes to figuring out what kind of options we should be trading, and how should we react to different volatility situations? We'll talk about certain strategies that might be appropriate. Again, not every strategy will be appropriate every single time, and you need to have obviously a lot of discretion and, of course, practice proper risk management to protect your capital. I always say that you got to learn these strategies before you apply them, and you should learn them in a simulated trading mode, which fortunately you can do that through TradeStation. So we'll talk about calendar spreads and how we can possibly benefit from differences in volatility between near-term and long-term. We'll also look at a couple other different strategies, what we call short volatility strategies. So we would sell volatility, expecting the high volatility to return back to a normal range. We have several strategies there, iron condors and iron butterflies. We have covered calls and cash secured puts that, again, allow us to trade the inflated premiums that typically come with the high volatility. And we'll look at ratio spreads and jade lizards. And those are going to be for limited price movement. Actually, most of those are going to be for limited price movement, which we would expect after a big move in price. A lot of times you'll see a big change in price, either a big, huge explosive rally or a big drop. Volatility spikes, and then we go into a bit of consolidation or slight price movement as the market recovers from that. So these might be strategies you can employ then. We'll also talk about trading volatility itself. We have the VIX index, which is the volatility index on the S&P 500, and you can actually trade option strategies on volatility or the volatility index. We're going to also identify a lot of mistakes that traders make and talk about how to avoid those, because obviously if we can avoid those mistakes from the get-go, we should have better results when it comes to our trading. But we need to know what are the dangers before we can avoid them. And finally, we'll talk about how to implement these strategies and build a plan Really, trading is not about getting rich quick. It's about building consistency. If you can have consistent wins and small losses over a period of time, hopefully as long as you want, then you have a higher probability for success. So we're going to talk about how to implement these and, again, become more consistent in our trading. So volatility is a measure of investor fear. They're projecting how much price movement they are expecting in a particular security or even the broad market going forward for the next 30 days. That's pretty much what you're measuring when you look at implied volatility. And with implied volatility, if there's a large unknown or people are scared of large price movements, they typically want to be compensated for that. So volatility is probably the biggest impact on option premium pricing compared to any of the other Greeks. We have Vega that we follow for that. The other Greeks being Delta and Gamma, which are going to be based on directional movement of the underlying security. You have Theta for time, and you have Rho for interest rates. But when it comes to the impact on most options that many people trade, typically volatility and Vega will have the biggest impact and will change the price greater than almost the others combined. So we really need to be careful with volatility. And when volatility rises, not always, but often option prices increase, which again is good if you're already long, but not so good if you've already shorted or sold those options. And when volatility declines, the option premiums typically go the same way. Again, there's always exceptions, unfortunately, but this is the typical price movement for volatility and option premiums. So when it comes to time, that's another factor we have to take into account. Options that have more time until their expiration have more risk. You think about it, the reason why the premiums are typically higher with higher volatility is anyone who is selling an option is taking on a risk of assignment. They want to be compensated if there's greater risk. If there's a higher probability of those prices going from out of the money to in the money, or deeper in the money, or in the money to out of the money, whatever it may be, they want to be compensated for that. So they're going to require higher payments, and that's going to inflate the options premiums. When you go out further in time, it makes sense. There's more time for prices to move in one direction or the other. And again, sellers want to be compensated, so the buyers are forced to pay a bit more for their rights when they buy options. Volatility affects options with more days to expiration than those with fewer. Yeah, it just kind of makes sense. So the further out you go until expiration, a 30-day versus a 90-day, the 90-day will have greater price swings based on volatility influence than the shorter time frame, the 30 days. So we can also adjust volatility or our Vega when we're doing spreads. That's another thing we can do. Instead of just taking one option, because when you buy or sell one option, you have to take whatever those Greeks are that are on that option at the time. And of course, they do adjust as prices and time passes and volatility moves. So you can see here that we have shorter time till expiration, 8 days on both the calls and the puts. When we go to 36 days, that volatility increases. 99 days, it's like triple, I think, more than triple. And 156 days, it has quadrupled the volatility effect compared to the short-term options. So one way of combating volatility effect would be to trade shorter time frame options that would lower your volatility exposure and your risk. However, if you're selling options, you may not want that. If we have only 8 days left, the premium may not be justifiable for the risk that we're taking. Whereas when you go out further in time, you get more premium, but you expose yourself to more volatility risk. Of course, if this goes in the right direction, volatility dropping, then you're going to have profits much sooner and greater with the longer expirations. As what I was mentioning before, one of the ways we can also offset is not just choosing the different times, but we can actually create vertical or some sort of a spread. When you create a spread, you're buying an option and selling an option at the same time, or sometimes buying and buying, or sometimes selling and selling, depends. So if we buy and sell an option, we would have positive and negative Vega that offset each other and therefore change the structure or change the volatility exposure of our position. So we can control that by adding what we call that offset leg. When you trade a spread, the first leg is the anchor leg. Example, if I go out to my TradeStation Option Station Pro, let's take a little bit more time. I'm just showing Microsoft for whatever reason happened to be there. And again, if I were to, let's say, buy this 485 call, right now the Vega is 0.55. It doesn't show down here, but it would show on the analysis page. However, if I were to sell another option, let's say I go up to these 500s and sell that one, is that going to work? Oh, I think I hit the wrong key. Oh, let's try this. There we go. Now that I'm selling an option, so when I go to analyze this option, there it is. You can see that my Vega has changed 2.69. If I had only done the initial option, and let's go back to just the long, I think that'll work, and analyze. Now we can actually compare the two against each other. So right here we had 55.36 for the 100 shares versus 2.6. We basically neutralize the volatility by simply adding an extra leg. And again, the initial leg is called the anchor leg. That typically drives your profit and establishes some of the risk that you're getting when it comes to your options position. The second option that you add on is called the offset leg. It offsets those Greeks and those risks. And that's why we do spreads. But when it comes to high volatility, as I've been saying, high volatility often means inflated option premiums. They're going to be overpriced or very expensive at the very least. You can take a look at some of the credit spreads to take advantage of this. As I said before, selling volatility is good when there's high volatility and you're expecting it to come down. When it's very high currently and option pricing is inflated, you expect it to drop. And we'll see how we can actually look at that. But one of the simplest ways, potentially, is to look at, which I don't have here, do I? The theoretical value. And I can go into the different columns. I'll adjust this for a moment. Let's see, we'll take off volume and open interest for now and add theoretical value. Now, it's no guarantee. These are theoretical values. They're not set in stone. But what we can do is take a look to see what is the theoretical value for that option and what is it currently trading at. According to this, if this call option is worth $11.07, but you could sell it for potentially $15, you are selling an inflated option. You are selling it for above its theoretical value. And it just depends on the model that they use. I believe this is Black-Scholes that they're using for the theoretical value. So again, we could sell options to take advantage of that because if the volatility does drop, then you are going to be able to buy back that option at a cheaper price. Remember, volatility dropping, option premiums should be dropping as well. It allows you to close out your position at a cheaper cost, keeping the difference. However, when volatility is high, it is possible for it to go higher. And obviously, you got to be careful. You can place protective stop losses. You can monitor your position, set alerts, whatever you might need to do to protect yourself, but you definitely should do something. And if volatility increases instead of drops, you could lose on that options position. So when we're trying to gauge the volatility, I showed you one way of looking at it, which is theoretical value versus the actual trading value or trading prices, I should say, the current market values. You can also compare implied volatility. TradeStation has a couple of different indicators. One is implied volatility, all options. And there's several others as well. In this case, this is the current implied volatility plotted on the chart for that security versus its average. And if we happen to be above the average, there's a high probability that we're going to drop back down. Prices and even volatility are elastic. What happens is we typically move away from averages and snap back. Move away, snap back. Move away, snap back. Obviously, the averages are moving as well with price as they average new data. But when we see that we are at extremes, typically volatility should come back to norm. If volatility is well above the average, selling volatility, looking for a negative Vega, may be a beneficial opportunity. You could also look to see how it's doing versus implied volatility. What I have here is a gauge that was created by a friend of mine, which basically we were taking the last year 52-week historic volatility, which is what has already happened, putting it as a scale. The 52-week low versus 52-week high. Actually, I can show you, I believe I have it on the chart right now. And there it is on Tesla. And it's very simple. It's drawing the last year's 52-week high in volatility, which is in this case somewhere around 1.11. So 111% on Tesla, and the low, which in this case is about 34%, and dividing that into 5 different ranges equal. And we've got 20%, 40, 60, and 80%. I can look to see when volatility, implied volatility, Again, this yellow line is the same as the blue, just on a different scale. When implied volatility is relatively high versus historic, here it ran up into the 60 percentile, not overly expensive, but definitely higher than it had been in the past. Notice we're well above the average as well. You can see volatility dropped. It went from roughly 85% down to 57%. That was a 30% drop in volatility. That's opportunity. It doesn't always happen right away. You can see there we expanded past the 52-week high, and that obviously the 52-week highs adjust as implied volatility adjusts and as prices move. So it started dropping, went a little sideways, and eventually came down towards averages. So you can create indicators or look on, there's a couple different websites that show historic volatility, which is, again, really the chart overall. It's measuring how much price movement has been there in the past 52 weeks, taking the high and low, those percentages, and plotting a range, and then just putting the current implied volatility against it. So we're looking for very high implied volatility versus previous. There's a couple other options. I was going to say options and opportunity at the same time, where you can actually create some scans, or you could also in the radar screen create lists. So for instance, if I add in on data, where is it here? Hot lists. So if I create a new page with a hot list, there it is, bringing it up. Under the activity, right now it's on price, but you'll see there are volatility lists. We can look for implied volatility. Let me do this, zoom in a little bit so you can see it. So right here, once you click on volatility lists and hot lists, you can actually look for implied volatility that's very high, or implied volatility breaking out above averages. The SV, that's statistical volatility, that's simply another name for historic volatility. So we would look to see a very low ratio because implied volatility would be high while the numerator, statistical or historic volatility, would be low. We could basically bring up any of those lists and then do searches on it. And before I do that, just so we could actually see it. So for the font, there we go. Only takes a moment. And now we can actually see some of the securities. So if we were to look, for instance, high implied volatility, you got to be a bit careful. We want to make sure that we filter this list for securities that are tradable and have decent open interest as well. We can add that in as an indicator. Again, just add a study to your radar screen. And my computer is running a little slow today. Apologies. It's actually my computer. There's a lot of things going on. It's not the platform. But for instance, I can go to open interest, all options, and I can add other things as well, obviously, but then we can actually search. Anyway, I can go to the open interest here, again, under my filters, and I can filter open interest, all options. Let's say is greater than 10,000. We want to have liquid securities, and unfortunately on that list, there's nothing. So maybe we don't want highest, maybe we just go to percent changes up. And again, you can do some more filters and check for things to see. I might be getting some bad data right now, that's why. But you get the idea. You can use radar screen to filter for some potential opportunities. There we go. We got some. Oh, it took the filter off. That's okay. So like I said, there's a lot of different ways for finding securities that currently have high implied volatility. And of course, we can look at the broad market and even the VIX when the market itself is moving very drastically, especially to the downside. Typically, you'll see implied volatility is very high and options become very costly. So when it comes to some of the strategies I'm going to be talking about, I may not go into too much detail on some of them. And the reason why, if you go to TradeStation's website, you can go to the Learn tab and open up the Options Education Center. So the link is there, and I'm sure we'll put that up for you as well. But if you haven't been there yet, there's a lot of good information. Like I said, this is the Options Education Center. Yeah, I might as well copy and paste it for you in the chat in case. There we are. Anyway, most of these individual strategies would actually be found here. So when I go in talking about, say, for instance, iron condors, did I already passed that one? I think I did. There's condors, but then iron condors, there they are. And like I said, many of these are going to be available in a lot more detail. I'm going to talk a little bit about Jade Lizard. There it is. So if I click on that, you will get a lot of information. Should be a video, a PDF article, and plenty of information. Some of these even have a workspace you can use to find some of those opportunities. So the reason why I'm bringing this up, again, it's a great resource for you. And this is where you'll also find the recordings of the videos as well. But I'm not going to be able to teach you everything you need to know about these strategies in this time that I have with you. I'm going to go over them. I'll talk a little bit about when they're appropriate to use and how you might use them. But to really become familiar with the strategies, go to that website, to the Options Education Center, take some time to learn those strategies and even practice them in a simulated trading mode as well. So, first one I'm going to cover is a calendar spread. And basically, a calendar spread is buying an option and selling an option. They're both going to be either calls or both puts. You do the same type of option. You're actually going to be using the same strike for a calendar spread, the same underlying security, of course. The only thing different would be the expirations. So we're going to be looking at different expirations, near term versus far. And as we saw before, the Vega or volatility exposure is going to be different. It's going to be greater on the further expiration than it is on the near expiration. This is also called a horizontal spread because looking at an options chain, you're not doing anything different on the strikes. You're doing just different expirations horizontally till they expire. And basically, we can look to see differences in volatility across time frames. You can even look at TradeStation's option chains, and what you'll notice, you can see some of the volatility right here for those particular options. I'm sorry, this is the volatility for that option series, and this is the expected price movement from current for the underlying plus or minus based on that volatility. Volatility is obviously changing, and these are estimates, not going to be, you can't hold it in stone that we're going to move up 37 points in 44 days on Microsoft or down that much. It's going to be approximate based on the current volatility levels. And you can look to see if there's some sort of skews where one of the numbers seems really out of place compared to many of the others. We have a little bit higher volatility on this 44-day. Notice that's at about 27, and we have 25 around it. Then we have some 27s close by. It's not too far off, but every now and then you'll get some skews with a volatility that might be extremely high or extremely low. Obviously, you notice that this front one, which only has 2 days left, has very high volatility, 40. And I'm not sure if that's going to be the same on other securities. But remember, the Vega is going to be extremely low, so it won't affect it as much. And you can see, yes, on Amazon, 2 days has 51. But then we go back into the mid to low 30s. But if you happen to see a spike in volatility on one series versus another, sometimes, most of the time, especially when there's big moves in the markets, it'll be on the near expirations, while the longer term expirations, prices are expected to return to the norm, and so is volatility. So the volatility might be lower. That gives us an opportunity to sell near term and sell the high volatility and buy the back months to cover the short. So that is a calendar spread. You can sell a near-term option and buy a longer option at the same strike, trying to profit from a drop in volatility on that near-term option, and hopefully just expires out of the money. That way the premium becomes yours. You're using the long-term option to cover the short on the near-term option. There's also what's called a reverse or short calendar spread, which you do the opposite. You buy the near-term option and sell the longer dated one. Now, remember, if you're selling the longer dated option, that will have the higher Vega. So if there's a skew where there's really high FAR volatility, you may end up doing that reverse calendar spread rather than the near or normal calendar spread. Like I said, you're basically profiting from the variance in time decay as well as volatility changing. So the closer expirations obviously decay faster. If you're not familiar, the theta or time decay on an option, it's not linear. It is curved, and once you get less than 30 days till expiration, the time decay explodes. It goes up exponentially. So the shorter term options being sold may not have as much profit from Vega. However, the time decay will be better. And again, if you have high volatility on the near options because of a big jump in the markets, could be, I know we've gotten a lot of jumps from volatility from tariff announcements. Again, we can go back in time and look at a chart. Go back to a chart, and I'm on the daily. We're going to be looking at the VIX a little bit later anyway, but here's the VIX or the volatility index. It's going to give me errors because of the options stuff. No big deal. And we had a recent spike here in October on the 17th. And you can see we've been getting, that's nothing compared to what we had before. As you can see, early in April, when the tariffs were announced, we went way up in volatility. Again, that'll inflate the short-term options potentially a lot more than long-term, giving you that opportunity to sell those to profit from the drop in volatility and the decay in time. So again, if we have high volatility currently, and this is not really showing it necessarily, but you can see the Vega, even though it's not going to be as great as a long term, you could still get an effect if the volatility is extremely high currently compared to the long term. And that typically happens when there's major events, even I wouldn't say necessarily on earnings on individual securities, but just geopolitical or even a big market slide when you go into bear markets as well. Fear is out there and it'll inflate those options. So the long calendar spread, in this case, you actually have positive Vega and they're going to lose value. Remember, this was selling the near-term option, buying the long-term. And what's happening with the volatility, we're gaining time decay. And again, this front option that you sell, this will happen to be December versus March. That one will decline in value much faster with the time decay, but volatility is actually going to hurt it a bit if it drops. Instead, you could do the reverse. And it was a little bit counterintuitive because you think, okay, we'll sell the front one because it's high volatility, but not necessarily. We typically want to have negative Vega. And remember, that longer term option will have higher volatility exposure, higher Vega than the near. So the drop in volatility will affect that option more than it would the front month. So you typically, if markets have gone crazy right now and huge volatility spike, you may want to look at the reverse calendar spread rather than the calendar spread. Again, you want negative Vega. Positive Vega means when volatility rises, the option values and the position profits. Negative Vega is what you want if you're trying to profit from currently high volatility, looking to see the markets return to normal and volatility to drop. So another thing we can do is sell volatility in time by going what we call delta neutral. Remember, delta and gamma are risk parameters that deal with the premiums changes based on the underlying security changing in price. So I think D direction, right? Delta direction. When we're dealing with iron condors and butterflies, we're typically what we call delta neutral, meaning we're trying to trade a security moving in no direction or any direction, but basically we're actually profiting more from the volatility Vega and theta, the time decay. Again, doing spreads, which is trading multiple options at the same time, allows you to neutralize certain effects of the Greeks and capitalize on others. And as I said before, these strategies are in much more detail on the Options Education Center, and you got the videos, workshops, and even workspaces that you can utilize there. So we're basically trading 4 option legs at the same time. It's a bull put spread, a bear call spread. Both of those are credit spreads. We're selling options, which again, you typically will want to sell options when you have inflated volatility and inflated options pricing. The condors, the difference between the two is just 4 strikes versus only 3 for the butterfly. As you can see, 2 of the options that are sold are going to be the same strike. So you'd want to use these after the big move when you're expecting the markets to slow down a little bit, maybe go a bit neutral. So again, if we go back to the VIX, we had that big spike in April, another spike in October. If we were to compare this to the S&P or even SPY, you can see the big price movement in SPY in April and also in October, correlating with that spike in volatility. What happened afterwards? For a period of time, we started going a bit sideways, then rallied a bit. Again, volatility might have changed there. Here in October, again, we went sideways for a couple weeks, and overall are still in a bigger range, but a range nonetheless. So you'd want to use the iron condors and butterflies when volatility is very high currently, options are expensive, but you're expecting the markets to go quiet after as a result of kind of everybody was crazy. Now we're calming down and trying to gather ourselves. So we're looking to sell that expensive premium. Again, you want negative Vega, so you profit from the drop in volatility. You'll also, because you're doing credit spreads, have negative theta, so you profit from the time decay. And you're basically, with the iron condor, selling 2 out-of-the-money vertical spreads. And the max profit is if prices at expiration are inside between those 2 options, the strike prices you sold. With the iron butterfly, often you have to exit this one. The reason why is as time's decaying, it is benefiting you. Volatility is dropping again, getting a benefit, but the max profit is only going to be if options that happen to expire right at the short strike. Okay. Yes, this is recorded. It will be available. So there's potentially more premium with an iron butterfly, but it's harder to target exactly where it's going to be. And you often have to exit. It'll have what we call a narrower price profit range. I think I might have an example for that. And as I said, you might have to close it out to actually lock in your profits before the options expire because there may be at least one in the money. And then you have to deal with the ramifications of assignment and exercise on your other leg that you had covering it. So to avoid that, you may just want to exit prior to the expiration of the options. It won't be the max profit, but it will be a profit, hopefully, nonetheless. It could be a loss as well, obviously. Just because these are limited risk, if you go back to the risk profile pictures that I had here, those are risk profiles. You'll notice they have flat legs on either side. This one's kind of covered. That means that there's limited risk. You can only lose up to a certain amount, but that doesn't mean zero risk. Obviously, if volatility rises, we're going to lose. We're trying to trade for volatility dropping. And also what happens with our delta, as you get closer to expiration, the sensitivity of these options to price movements becomes much higher. So while we were profiting from volatility dropping, the effect becomes less and the price movement becomes a bigger impact on us. So we got to be careful with that. You also have to make sure you have enough capital to cover the potential losses you might incur in trading those options. Or assignment. You are short an option at any time, unless it is a European style option, you could be assigned at any time. Typically, when you trade options on stocks and ETFs, you are trading what they call American style options. Options on indexes can be European style, which means there's no exercise until the expiration itself. So it protects you a little bit, but you got to check to see what type of option you're trading. Because again, if you have an American style, even if the option is out of the money, you still have assignment risk. It could happen at any time. So again, if I go back to my example, actually there we go. I'm looking at Amazon right now, so I'll just use that. If I were to build an iron condor, first, I would look at the underlying security. I would hopefully expect volatility to be very high currently. And again, we're looking at theoretical value. It happens to be lower. I'm not sure if I got a suspect feeling that this may not be accurate in my demo account right now, but you want the current pricing to be above the theoretical value. So you're selling expensive options. I could actually also go back to my charts. Now this one, and AMZN, thank you. Helps to get the right security. And this is not really inflated currently for the volatility. You can see that we are currently below the average and low in the range altogether. So I probably would not want to do the strategy, but just as an example, I would look to sell options below the current price where we are not likely to go before the expiration. So I'll do this 210, and then the next leg will adjust my risk. Remember, this is where I'm getting the majority of my profit. I'm selling the option, and let's get rid of that call that was there. And now I'm adjusting my risk parameters because I currently would have selling this. Where's the Vega? There it is. Negative 0.22 or negative 22. I have a negative delta, so I profit from prices going down. And I have negative theta, so time decay is my friend. I profit from that time decay. By buying the other option, notice my max loss goes from $20,000 to $375. I've locked down my potential risk. I've also narrowed down the potential profit as well and changed my Greeks. I'll do the other side. That was the bull put spread, the bear call spread on the opposite side. Let's see, I did 210. It's about 10 away. I'll do the 230 and 235. So again, the short options are the anchor legs trying to drive the profit, in this case, the credit I'm receiving. The long options are there to protect me. So when I go to analyze, we'll see the risk profile. If I get rid of the extra option that was there for some reason, there we are, the iron condor. Again, limited risk. You can see my risk profile at expiration. I cannot lose more than the maximum risk, which in this case happens to be $215. My max profit, $285, as long as we expire between those two short legs. And of course, there's a little bit of a range before I go negative if we happen to go outside. If volatility drops, remember, I have a negative Vega. It won't be as great as if I just sold an option, but my margin is going to be much less. So if we look at, let's say we go negative, hold on a second. Before I do that, let's go plot one, and I'll just keep last price as an example. There we are. Not any price movement, just volatility dropping by 5%. Should have adjusted. Actually, let's go not at expiration and not right now. So I'm going to change and do, let's see, a third, about halfway there, 15 days. There we go. So again, going back on the volatility, no change in volatility. In 15 days, the time decay will give us a small profit, $65, not the maximum, which would be $285. But if prices stay right where they are and time goes by, we make 63 bucks. However, if volatility drops as well, now we're up to $96. We saw that volatility could drop quite a bit. Let's suppose it goes down 30%, $284. We're almost at max profit. Prices didn't even move. Time decayed a little bit, yes, halfway through the option's life, but the volatility was the big impact. Once again, though, we have to be careful because the closer we get to expiration, the less volatility will impact this. However, the time decay will become greater, but our risk gets greater with the directional movement. And as I said before, this is the risk profile for the iron condor. Let me go ahead and add in 2 price slices just to show you. This is the break even. Those 2 levels are roughly the break even at expiration for the iron condor, right? If I change this to a butterfly, you'll see the change in the max profit and max loss as well. So we'll sell, let's see, 220. What are you doing here? Short call. Oh, it's not letting me change it. That's weird. Try and change it to 220. So let me go back. Instead, this was 210 and just recreate it. That's fine. It'll be easier to do that anyway here. So again, the put and change it from an iron condor to an iron butterfly, just so you can see the difference. You see it says iron butterfly now. I go to analyze, and there's the iron butterfly where I changed the 2 strikes that I'm shorting. And notice the profile, my break even is closer, which means I start to lose money faster, and it's very narrow for getting the maximum profit. Maximum profit is much greater. I've also increased my max loss, though, as well. I've increased my volatility exposure, which is good. Again, the prices will change faster. If I take out the change in volatility here from 30 down to 0, you can see 15 days from now, time decay works for me, but it works much better, not 50%, 5%. It works better when volatility drops, 10 up to almost $300 profit. So again, with the iron condors and butterflies, you have to decide how much risk you're willing to take, how much activity do you want to have to place on this, because with the iron butterflies, you may have to monitor it a bit more and exit prior to the expiration, so that way you don't have to deal with the assignment and exercise. With the iron condor, those are typically often held till expiration as long as you're not being threatened. So we have a couple other strategies, and another strategy would be covered calls. So high volatility, as I keep saying, inflates options premiums. If we have high options premiums, we want to sell that option premium. You could potentially generate income on stocks that you already own. You basically are selling options or selling calls on those particular securities. It, in a way, it gives you a limited downside protection because, or even recovers a little bit because you're selling and collecting premium that effectively lowered the cost of owning that particular security. The premium that you collect kind of offsets that cost you paid initially. But if you sell a call, you have to be aware that if you get assigned, you will have to sell your shares at the strike price that you sell. So typically you want to sell an option above a level that you don't expect prices to get to, or where you're okay with getting rid of your shares. Cash secured puts are also an interesting thing because remember, if the markets have crashed, obviously a lot of securities are cheap right now, but options, because of the volatility, might be expensive. What you could do, if you have the money to buy a security and you were getting ready to buy this stock anyway, you could possibly get paid while you're waiting to purchase that security. You sell the put at the level that you want to own that security. Again, you must have the capital to actually buy the shares in your account. If you don't have that money, you have to do a different strategy. And with the cash secured put, if prices go to that strike or below, it's not guaranteed, but there's a probability of you getting assigned, meaning you would buy those shares at the strike price, and you got to keep the premium you collected when you sold the put anyway. So you were paid to wait to buy the security. And in effect, because the premium was collected, it lowers your cost for buying that security. The risk, obviously, is if the prices keep going down, now you own the stock and you're getting in a big losing position. So obviously, once you own those shares, you'd want to put in a protective stop loss in case prices do not turn around. But this may be an opportunity to get your hands on different securities at a cheap price. Remember, if the market's crashed, the volatility is high, you're collecting extra premium, and you're able to buy cheap stocks, or cheaper, if you will. You're literally being able to buy securities at a price they didn't even reach. So again, as an example here, I'll use a different security. Let's see, I'll just go to AT&T. Doesn't really matter. So for instance, if I were okay with buying 100 shares at, let's see, I'll do $22 or maybe 23. There's not much there right now. Probably should have picked a better security. But here I would sell the put, and you can see the max profit is the premium I'm collecting at the get-go, which is not huge. It's only 12 bucks. Okay. I probably could use a different security, but that's okay. My max loss, once I buy those shares, I would own those shares, and I need to have the $2,300 to actually purchase those shares in my account, because I would be obligated to buy 100 shares at $23 if it is put to me at assignment. The risk, obviously, is if we go all the way to zero minus the $12 that I took in. So looking at the chart, that is a cash secured put. It's called that because you have to have the money in your account to afford purchasing the shares. And if you buy the shares, technically you're buying them not at $23, but at $22.88, because that's where you're assigned and you collected that extra premium. So again, it's a way of potentially buying shares a little bit cheaper, or at least getting paid to wait to buy the shares. And both of these will give you a little bit better premiums if volatility is extremely high at the time. I'm trying to keep an eye on my time here. Anyway, so we're good. So we got ratio spreads, and a ratio spread can have undefined risk. You got to be very careful with this one. I won't spend too much time because you really need to be a lot more experienced to trade these types of options, because you're going to be naked on one of the options. You could do what's called a put ratio spread, which is basically a bear put debit spread. So you're buying a put, selling a put, but you're basically selling an extra put. So you're naked on one put, which gives you risk from whatever strike you sell down to zero. It obviously, because you're more short than you are long, it profits from a drop in time and also in volatility. And again, if you have the expiration with the underlying at the short strikes or even above, then you get your profit as well, because the long put, that doesn't profit. You get the premium. And the call ratio spreads, again, this is a little bit more of an advanced strategy. This is probably one of the greatest risks that you could possibly take. It would be buying one in the money call and shorting two out of the money. It should be calls, not puts. I apologize there. You always use the same type of security here. There we go. And like I said, this is probably the greatest risk you could ever get with options, being naked a call. So again, this profits from volatility dropping and time decay, but you have to be very careful, because again, you can see with the put ratio spread, in this case, we're expecting prices to go up. If it keeps going up, we lock in profit a little bit lower, however, than our maximum. But if it goes down, we're pretty much unlimited. And the same thing with the call ratio spread. You have that unlimited risk because prices could go up forever. So you see max risk, it shows infinity. Not necessarily a good thing. There are better opportunities, especially for newer traders. One way, actually, this one's kind of similar to the iron condor, I think. Basically, again, it's called Jade Lizard. And as I mentioned before, in the TradeStation Learn section, the Options Education Center, this is one of the strategies that's actually listed there. Many of those strategies I just mentioned are also listed there as well. So you can go in there under Learn, Options Education, and all the strategies are here. As I scroll down, you'll see some of the webinars, including this one. That'll be posted for you shortly. So again, with the Jade Lizard, it's all about selling premium. It's similar to the Iron Condor. You're just missing the long put. So once more, you're going to be naked on one option. This can be done on a security that you're expecting to go up, but also might be a little bit more bullish than you expected. As you can see, it still profits as prices go up. It gives you a little bit better of a range than the ratio spread to make maximum profit. However, with a naked put, large downside risk. You can use stop losses even on the options. As a matter of fact, when you go to the Options Education Center, just to make note of this, where's it here? You can see there's a section and article, webinar, all that good stuff on activation rules on options orders. And that'll help you with learning how to place stop losses on your option spreads, which is a very good thing to protect yourself, try to lower the risk. So to time the entry, when it comes to Jade Lizards, This is really good after a big market drop, as I said before, and you're expecting prices to maybe go a little sideways, slightly bullish. However, if prices go up a lot, you're still going to benefit from this. You are going to be selling the volatility. So you want volatility to be very high, and you're expecting that to return to the norm as prices stabilize over time. So volatility should be dropping, prices should be going slightly up. And as you can see, it's like the iron condor without the extra leg on the downside to protect you. Plus, on the call side, you actually still make a profit even if prices keep going up. It wouldn't be the max profit, it'd be less. In this case, we're looking at about $200 versus 388, almost 400. But you are not protected on the downside, so you need to have margin to cover this particular position as well. Basically, the margin that would be needed for a naked put. As you can see, we got negative vega, so we're profiting from volatility dropping. We have positive theta, so we actually are losing a little bit as time decays, but not as much as we're profiting from the volatility drop. And this is slightly bullish with a positive delta. And that's visual. You can see that at the time, the current price was about 109 right in here. So if prices stabilized and volatility calmed, this would profit, and you could potentially profit the maximum at expiration. If it were to go up in price, as you can see, once it hit 115, you basically have gone as low as you're going to go on your profit. And it could get better if it were to go back down again or stay the same. So continuing on, because I'm getting low on time here, sorry, but we can also trade the VIX. As I mentioned before, pretty much all the same strategies can be applied to trading volatility itself. And the VIX is a tradable index. Itself is not, it's not tradable. You can trade the derivative, the options on the index. And it's implied volatility on the S&P 500. So trading options on the VIX is like trading volatility, options on volatility. So we can use all those same strategies. If you're expecting a spike in volatility, you could use a bearish volatility strategy, which would be selling volatility. So really, I could probably add to this. You'd want negative vega right there. So basically you sell volatility and expecting, I'm sorry, that's the other way. Spikes in volatility, we want bearish strategies on the securities because with volatility rising, it was right the first time. With volatility rising, you're expecting securities to drop. However, most of the time we don't know before it actually spikes. It'd be great if we did. Typically, we're going to see the volatility spike first and then try to trade it going back to the norm. And that's where you're selling the volatility itself. And I said this earlier, the VIX volatility, just like price, has a mean reverting nature. It moves away from the average and then snaps back. Moves away, snaps back over and over again. Even when it goes below, it typically snaps back to the average. So you could always chart the VIX, do it on this chart, as I had it before. Look at that pop-up error. It's okay. And you could possibly put in some averages in there as well, depending on which ones you like to use. And volatility goes up and down around the average. Right now, we have slightly inflated volatility, don't we? Not too high, but much higher than the norm. So we may be getting into an environment where selling the VIX, in this case, you could do bearish strategies on the VIX itself, or look for inflated securities, again, where the volatility is relatively high, and look to sell, get negative vega on those securities using those strategies I mentioned. And if you wanted to trade options on the VIX, you can see they're very liquid. I showed open interest in volume. Just to give you an idea, there's plenty of trading going on the VIX itself. Therefore, the spread should be pretty narrow and you should be able to get in and out pretty easily. Getting into common mistakes, things we want to be avoiding. Don't jump in without planning. You get that fear of missing out and people just jump in on things. Make sure you have a plan and analyze all the securities in the trades you're looking to take before you get in. You got to be careful, obviously. Don't over leverage. Have a limit for how big you're going to go. You shouldn't overall, most professionals don't want to risk more than 2% of the account value on an individual position. So you can adjust your size of the number of contracts or the securities you're trading overall. So be careful. If you need to use lower price securities, maybe lower premiums, you can adjust the dates that you're buying or selling. Obviously, more time, higher premiums. But just be careful and make sure you understand what is likely to happen to the markets going forward. See what the current volatility is and what are you expecting to happen in the future and trade for that. If Current volatility is extremely high. We have a spike. The likelihood is that it's going to revert back down to normal. We would sell volatility. Again, sell the Vega with those strategies we mentioned. If volatility is currently low, extremely low, it may revert back up. We could look for buying volatility, but have different strategies available and create a plan for whatever market environment you're expecting to happen. So make sure that you manage your positions, have a plan and stick to the plan. A lot of people will cut their winners short and hold on to losers. One of the things that we did a while back, also in the Options Education Center, is planning trades. If you go, I think it's under the options webinars, there it is. Plan the trade, trade the plan. You can create plans and tactics. Now, of course, creating them is one thing. You got to make sure you follow them as well. But create rules for taking profits and stop losses so you don't hold on to losers and don't cut the winners short. Be aware you have assignment risk. Make sure you have enough capital so you don't have to worry about margin calls on the options that you're trading. Anytime you sell an American style option, you are at risk. When you go to implement these trades, as I said before, go and practice them as much as you need to until you feel comfortable executing and managing the trades in sim mode. It's great. You can always refresh so you don't lose any money. The problem is once you get into live trading, your psychology changes because nobody cares as much about losing money in sim as they do in live modes. Obviously, we need to be careful. But create rules for your position sizing. Don't get emotional. The market doesn't care. You're not going to get back at the market. You're not going to get even. It doesn't matter. Okay? We need to be logical about what we're doing and don't change what you're doing in your trade, veer away from your plan just because you get nervous, especially if things aren't going well. Make sure you completely follow your plan and change things based on feedback from your data, not by your feelings. And it's great to actually have plans because you know what you're supposed to be doing when something happens and plan for those things. Plan for the bottom dropping out or volatility spiking or volatility dropping. Know exactly what you're supposed to be doing for those different scenarios. Have a plan for each of them and follow those plans. That way you're not reacting and doing the knee-jerk reactions, the impulse trading. You can actually, as you're profitable, I was just doing this with my mentees, my class today. We were adjusting stop losses on option strategies to protect our profits and allow our winners to keep going based on our rules, not based on, oh, I need to get out now and lock in profit. Okay, we didn't have that emotion going on. We had logic, following the rules. And again, just match the strategy for market conditions. If you're looking for volatility to rise and you're basically going long on volatility, you look for big price swings. You want to profit from positive delta and positive vega. If you're expecting volatility to drop, you want negative vega. Delta might be neutral. So it looks like I ran out of time. Again, if you need more information on the individual strategies, there's plenty of info for you on the Options Education Center. If you have additional questions, first of all, you can type them in the chat right now. I'll see if I can get to any of them. If they're relatively easy, I could try. If not, you can always email education@tradestation.com and we'll get back to you. They'll forward stuff to me to let me know as well, and I'll help to answer those questions. So I want to thank everybody for taking some time to learn about options opportunities with high volatility, navigating the chaos of the market. So thank you, Jesus, for having me. Appreciate it.
Oh, thank you. Thank you, Brandon. And just to answer the last question, the recording is going to be available in about a few days. We do have to go through a process of editing and also compliance review. So it's not going to be until a couple of days that we have the recording available. Peter, I apologize for that. But you can go into the TradeStation YouTube channel, and that's where we post all recordings if you want to find them quickly. We'll also post the videos to the Options Education Center. So use that link that Brandon shared with you guys right there in the chat. Options Education Center has access to all the webinar recordings we've done for options. So make sure that you explore and see all the things that are there. Brandon, everyone else here that's joined in the class, thank you so much for your time. Have a wonderful afternoon, and don't forget to check the events calendar for any upcoming topics, okay? Great having you. Goodbye, everyone.